Hey, welcome back to the live stream. My name is Victor, and this is Victor H Investing. I'm an individual investor, primarily a value investor in stocks, and I like sharing my analysis on YouTube so that other investors can look at it and hopefully investors find it interesting. I've been investing for a long time and I get a lot of value from watching other YouTubers share their analysis on YouTube. And a few years ago, I started to record videos and share my analysis as well. It's been an interesting endeavor, and I hope that viewers find the videos interesting. Looks like we have our first attendee. Thanks for joining. And just to do a sound check, can you hear me all right? All right. So looking at this week's trading, it was good to have a positive week of stocks. We had 3 consecutive negative weeks, and I think the loss was well above 5.5% in the S&P. If you look at 3 weeks going back to call it the beginning of April. So it was good to have a positive week in the books. Having 1 week in the books, and it was a good week where I think positive earnings really pushed the market higher, which is very good. I think the market had been kind of digesting some of the Federal Reserve changes. You know, when we started 2024, there was an expectation that there was going to be several rate cuts, and that's not going to happen because inflation has stayed higher. And also the economy is showing pretty good signs of growth. Not great growth, but some growth. Unemployment is really low. So it puts the Federal Reserve somewhat on idle. You know, I'm not sure if they're going to cut this year. I imagine once, maybe twice. I don't think they're going to raise interest rates. I think that would be really badly received by the market and by consumers, by the administration that's in office right now. I think they couldn't get away with that. So I think that's going to be the case where they're just going to stand still for a long time in 2024. Looking at the performance, and I see I've got a couple of viewers. If you can do a sound check, I'd appreciate it if you can leave a comment saying if you can hear me. I'd appreciate it. All right, so looking at the performance of the week, just today, stocks were up 1%. And that's a really nice increase in one day. And for the last 5 days, up above 2% as a whole. That's really good because prior to that, you know, looking at going back to April 19th, it was down, you know, considerably. And we are up 2.67 from the very bottom. But from the top, which I think was March 28th, to the bottom, we're down 5.46%. That's a pretty good drop. And it was good to have that drop. If you have a market that just is going up on a tear, this is unsustainable. It's a really beautiful graph to go up, you know, from the fall of 23 up to March 28th, we went up 27%. Well, that's really fun. It's a fun ride up, but it's unsustainable. So it was good to have this pullback and have prices come down. And some prices on some stocks came down much further than others, and that's really healthy. So, hey, thanks for tuning in. Is it Bad Omen? How are you? Good to see you. So in general, I think having a good pullback of call it 5.5%. And then having a positive week where you had earnings really push up stock prices. To me, that's the feeling that I get when we're going to start a new rally. So I would not be surprised if we saw stock prices go up next week, assuming earnings continue the way they've been going. And I'm going to review earnings for a couple of companies that I think really showed up this week. And I'm also going to show earnings for a couple of companies that were really call them losers, or their stock prices went down. But in general, I think if we have positive earnings next week, which we will have a good number of them, we will go up considerably higher from there. So that pullback, I think, is good news. What was really beginning to get uncomfortable was this constant, increase in stock prices. It was great, but it just began to feel like there was just too much euphoria, too much greed, and that we were going to get a terrible, correction as a result. But now some of the tension's been relieved, and we had a nice little pullback. We'll see where the stock market goes from here. All right. So looking at the market, I wanted to start, with some bad news, and start with Intel. And if you want to put a comment down of a company you want to talk about, please do so. Hey, Shadow Guy, how are you? Good to see you online. Thanks for joining. So Intel, it was interesting. A couple of companies provided their earnings, and they did well in the first quarter, but their guidance was not really well liked. And that was interesting. And bad omen. I'm going to talk about Toyota next. And Random, thanks for joining in. I appreciate it. So Intel came out. They had a good quarter. They grew well, but they guided down in the second quarter. But then they also said that in Q3 and Q4, they're going to have good revenue growth. Well, the market just kind of sold off 9%. Now I'm investing in Intel. It's not a big position at this point. I have in the neighborhood of $4,500 invested. I think I'm losing 14% of my position after this pullback. But I believe, Intel is going to be a bounce back story where they bounce back and the stock price will be worth more once they get their business back in order. So in general, I thought this one, Intel was a little over punished. That's my opinion. And we'll see where the stock goes from here. I'm a value investor, and I like buying stocks where everybody hates it. I think there's a lot of value. I buy into it. And then 6 months later, maybe 12 months later, everybody likes it again. And then the stock price rises and I make money. Wonderful. I think Intel is going to be in that category. And they do have a lot of work to do, but I think they're going to get to it. So, all right. So that's Intel. Now let's talk about Toyota. And I don't cover Toyota very closely. I think very highly of their brand. Who doesn't like their brand? Over the 1 year, they're up 67%. Awesome rise. Here's the story, or I should say, one of the lessons to a value investor is you could buy these companies that are really good companies. Toyota, I would argue, they're one of the best brands in automotive in the world. Period. It's the quality level, their designs, a lot of things, the value you get, right? You buy a Toyota, you can own it for a long time. All those things exist. So as a value investor, I really like buying good companies that have good fundamentals, and you can wait around and wait for the right time and then buy into a stock. Now I'm a Ford stockholder, which is why I don't buy into Toyota. I like the Ford fundamentals. So I'm not going to buy a lot of automotive companies. But this one here, whoever invested in the late 2022, even into the spring of 2023, you basically are doing great. You're up 85. Well, I don't know about 85%, probably about 80% on your investment. So I think highly of Toyota. Looking at some of their financials, really good growth in 21 and 22. Really good sized company. Their market cap is 317 billion and the revenue is 308 billion. So you're paying like 1 times revenue. That's great. Net income 31.7 billion. So you are getting basically a 10% return if you look at net income. That's a very good ratio. Very good ratio. Dividend, they pay a small dividend, 0.88%, and their forward P is 12.58. So overall, I like Toyota. Let's look at, so we looked at their revenue growth. That's good. Cash flow did dip from operations in 22. Looking at their balance sheet, debt to EBITDA is a little high. 4.37 is high. I think that's one item that I don't like about them. And I have looked at Toyota, but I've never invested in Toyota. And it's been a long time since I looked into it. Looks like their earnings per share is expected to grow quite a bit. And well, it grew a lot in 2023. And it's looking to grow a little bit in 24 and then some in 25. So I think like what I'm seeing out of Toyota is the stock is up 67%. So that's usually means that I would be late to the party potentially. So I'd be careful in buying into the stock at the right price. That's what I would do, but that's an opinion about Toyota. I own a Toyota Tacoma. It's 2014, and I've owned Toyotas pretty much since I started driving. So I think very highly of the brand. All right. So Random, thanks for tuning in. Shadow Guy, this was a good week. And you and I are on the same page on Intel. Yeah, good companies in Intel, I put in the category of a good company. I know they've had a couple of tough years, but you look at, who built the PC industry, Intel is right there. They have so much of their product integrated into various parts of our economy that I think they're going to be back. And once they're back, I think they're going to reward investors. Looks like you got out of Intel around 34, 35. I continue to buy into Intel. Just a quick comment on my investing style. So, picking exactly when a bottom is going to be hit on a stock is incredibly difficult. If anybody claims they can do it, they'd be the wealthiest person on earth. But knowing when a quality company is discounted it takes some work, it takes some calculations, it takes some experience, business experience, researching the industry, and then buying at the right times. And I feel like I'm buying Intel at the right time. This company was worth $60 a share not too long ago. 2 years ago? This company is a $54 billion revenue company. You're getting the company for almost 3 times revenue. Once they get their foundries in order, they get their business in order, and they start selling, I think the capacity that they can sell, this is at least a $60 stock, maybe $90 stock, maybe higher. And I'm willing to put money and park it in companies like this because Intel is a good brand. In my opinion, it's a good business. And they have a new CEO that's really good. It's not like we have a CEO that's been there for 10, 20 years and was kind of the mastermind behind the big meltdown. No, Intel is having its issues. They hired a new CEO. He's trying to fix things. And I think fundamentally the company's headed in the right direction. So we'll see how it goes. Okay, so Random. So my take on Intel, they're diversifying into foundry company. Those take a lot of time, take a lot of money. You are correct. Now keep in mind that the other foundry that's out there is TSM. TSM's biggest foundry um, in the world. And they are also, I think they're like the seventh most valuable company on the stock market. Foundries become really valuable because they become very powerful. And it is good to know that Intel has its own foundries. Companies like Broadcom, they're a fabless semiconductor company, meaning they don't have a foundry. They depend on TSM. And I think that that is both a strength and a weakness that you'll have in an Intel. The strength in having your own foundry is you control your whole supply chain. The weakness is you have to put in the capital and run it right. So if they can do it, they can pull it off. That integrated business could be really profitable. So we'll see if Intel can come back and if they can become a viable foundry. And look at this foundry here, TSM, 70 billion. We just saw Intel, it's a $54 billion company. So Intel's not that much smaller than TSM, but the market cap is 1/4 of TSM. So if Intel can become profitable, grow their business maybe to 60, 70 billion, why wouldn't they be similar in value to TSM? They're a foundry. They actually design their own chips. They will produce for other semiconductors in their foundries. So there's a lot of things there that I like about Intel. All right. So good comment on their foundry business. All right. So next one, random. I'd stay away for the next year. So I guess on Intel. Yeah, I mean that's one way to play it is kind of, stay away from Intel until you see that the business is back in order. Now the tough part about it is when you look at a company that's down, right? When do you get back in? Do you get back in a little early? That way the stock price doesn't go up on you, or do you wait until you know for sure? Because you may show up to the party a little bit late, like, hey, it goes up 10, 20%. There's some good news coming out. And then you get in and maybe miss the first 10, 20% of the rally on a stock. So that's one of the things. I try to average in my buy. So I average in, and that way I catch a good zone of when the stock is down. So right now I bought about a little over $500 worth of Intel today. And I'm going to continue to buy at these levels, especially on pullbacks. Like today was a huge pullback, so I bought more shares. And I'll continue to buy shares. I have about, I think the position is worth about 3,600 on Intel. I'm willing to invest, $25,000 or so. And if the news keeps getting more positive, take it up to $40,000. And maybe over the next 2 years, build it up to $50,000, especially if it starts appreciating. All right. So good stuff. Thanks for the comments. Looks like random. One more stock I'd like to hear about is EG. So what is EG? Everest. Is it Everest Group? Is that the one random? So Everest Group. So these guys are insurance products. Okay. So insurance. And insurance has been doing well. It's been doing well for me. I own Allstate. I own Prudential. Both have been doing really well. So this company pays about a 2% dividend over the last year. Wow. So this has been up and down. This volatility is interesting. It's about a $15.8 billion company. And the revenue is 14.5. So about 1 times revenue. Good net income. Forward PE is only 5.8. That's pretty low. Analysts are saying buy with a price target of 17% above the current stock price. Okay, so on the surface, it looks interesting. Let's take a look at growth. It's been growing its revenue top line. Okay, that's good. Cash flow. So cash flow. So it looks like it doesn't need any CapEx because you got cash from operations is here. It's been growing. It grew a lot in 23. And no, so this looks pretty interesting to me. Why is it that the price is suppressed? So 366. It's a $15 billion market cap. And the reason that I'm like, what I'm looking at is if they're making $4.5 billion of free cash flow because they don't have any CapEx, the company's basically making about a fourth of their market cap in free cash flow. That's a very high ratio. So it looks good. If you look at their balance sheet, debt to EBITDA is 1.5. Man, this looks really good. So what's keeping their stock price down? What's your comment on that? Random. All the fundamentals look really good on this thing. Why is the stock price down? And I'm going to do more research on this one because this one looks really good. The other thing I would look at is the revenue. Man, the revenue has been growing really nicely. Look at this. You got from 16 positive top line growth till 23. Amazing. So the fundamentals look really good for this company. It just kind of, it feels a little bit like, why are the fundamentals looking so good and this stock price is just going up and down? Why isn't it going, straight up? Kind of like the Toyota example we just looked at. That has somewhat of a smooth chart going up and to the right. With the fundamentals that I'm seeing for this company, it should be going up and to the right. They're kind of an insurance reissuer. So I'm going to look into this one and see if I can get my head around it. Good idea. Thanks for the suggestion. All right. So, all right, Shadow Guy. So you're from Santa Clara originally as a kid? Oh, he went to the Intel Museum in San Jose, I believe. Yeah, I've been to it as well. I think it's near, I'm going to call it downtown or Old Town San Jose. It is interesting. Okay, so next one is Matagonia. Love to hear your latest thoughts on DocuSign, Chegg, and Zim. Love to talk about all three. All right, so let's talk about DocuSign. So DocuSign is I'm going to call them a software company. And if you're not familiar with them, if you do like signature capture, if you're buying a house, especially, and you have to like sign a bunch of loan documents, oftentimes you're using DocuSign because it just makes the process faster. You can sign on your computer, on your phone, and so forth. I think it's an undervalued stock. If we look at the height of this stock during the pandemic, it was really high, right? And then it just crashed down. Okay. So you would think to yourself, wow, their revenues must have dropped big time. But no, revenues have been going up, 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 up. The most latest year, they grew by 10%. To give you an example, companies have been growing 10%. Their stocks have been going up and to the right. So this company here also produces really good cash flow. Cash from operations has been increasing. So that's higher. Let's look at their earnings per share. Earnings per share for 23 was 36 cents a share. It's really gone up to 3.30 a share. It's going to go up to 3.58, 3.74, $4. I mean, this is a really good value. Who competes against DocuSign? Well, these guys are the number one, signature capture company. They're used by real estate agents, law practices, you name it. They're integrated in software programs like Salesforce and other big software programs. So these guys are really entrenched. So it's very hard to, eliminate these guys out of the digital, call it the digital process in a lot of documents. So I like a lot of things about DocuSign. We look at their revenue, $2.76 billion company, and their market cap is, let's call it 12. So you're looking at like 4 or 5 times sales for the company. This is a high-tech company. They have very good IP. And I believe these guys are going to get acquired. A big software company looks at them and says, hey, I can add almost $3 billion of revenue to my P&L as a bigger software company. They're going to add cash flow to my company, and they're profitable. It's an acquisition target, in my opinion. Their forward P is 18. It's a growing technology company. I mean, sign me up. And I am an investor in DocuSign. Let me tell you how much I've invested and where I'm at with the investment. So DocuSign, I've invested $13,260 and my investment's worth $15,208. So I'm up 15% on the stock. I still think it has upside. I'm careful with smaller companies, because they just don't get the same valuation as a big company. You look at, like Google today or Alphabet, they grew really nicely. I get it. And their stock's up 10%. They're already a $2 trillion company. We're looking at DocuSign. It's 11.75 billion, and they can't catch a break. So they did go up quite a bit. I started buying at the right time. This stock provides opportunity to buy in really good areas. It's been going sideways. This run up was caused by somebody out there, a private equity group wanted to acquire the company, and it didn't happen. But my whole instinct of, hey, these guys are going to be acquired, it proved to be true if you look at that private equity group's offer. All right, the next one that you listed was Chegg. I really like Chegg. I may be wrong about it. I may be too early, but let me tell you why I like Chegg. So you look at their stock price, it's a collapse from the COVID era. And students use Chegg. It's kind of like a tutor, on-demand tutor, a lot of lessons and so forth. And first, these guys are growing their profitable free cash flow. But if you look at their investor reports, they have a very good AI business. And if you think about what they do, which is they give students, and I have a son in college, he uses Chegg. He pays $17 per month. And it's a subscription like Netflix or whatever other subscription you would pay. We look at their financials, they have been going down. I think they've had some loss of revenues. I think that is probably why their market cap's really gone down. Their stock price has gone down. But they do have cash flow. They've been cash flowing really well with very little CapEx. So really free cash flow is about $170 million. And their market cap is $730 million. So just in free cash flow, these guys are doing 22% yield on their market cap to free cash flow. So that's not a bad, risk for me to take. So on Chegg, I'm careful not to put too much money into this long shot, but I've got $8,264 invested. My investment's worth $6,000. Right now I have an unrealized loss of 27% on Chegg. And the reason it's just been kind of a downward stock. This too is an acquisition target. because, another company can acquire them and put pretty much you're buying the company for one-time sales, and they very quickly get one-time sales, they get profit, and they get free cash flow. So I like Chegg. Zim. So Zim has been, it's had a really nice 5 days. It's up 29%. It had a really nice day today, I believe. Today it was up 16%. So it's really cool to see Zim just really take off. And Zim is a freight company, ocean freight company. And if you look at the last 5 years, I mean, we're seeing a lot of this correlation, right? During COVID, certain industries just really took off. This stock was trading up at $78 a share. And then that's because shipping rates were really high. We had these supply chain issues where freight became really expensive. It was like 4 or 6 times more expensive than typical. And freight companies were making a lot of money. So they really benefited from that. Now, since then, freight rates have really come down. But I think it's the stock price. What usually happens with stocks is the sell-off goes beyond the value of the company's stock. And then it starts getting sold at a really good discount. In this case here, you can see the big drop in revenue from 22 to 23. So is it drop in the stock, fair? I think so. It's correlated to their drop in revenue. So that's fine. But even so, as we look at cash flow, they generate cash from operations. They continue to do that with very little capital expense because they already bought their ships. They don't have to buy ships every year. And they really improved their fleet when they made all that money 2 years ago. So they have a very efficient fleet. So they're making roughly $1 billion of free cash flow. And the market cap is 1.6 billion. So it's very easy math. The company's generating 70% of their market cap in free cash flow. Now, if shipping rates continue to rise, and they have been rising because there's been the conflict in Israel, among other factors, I could see this stock just really take off. It's had a really up and down kind of, stock kind of chart. But this one here, let's see how much I have invested. So on Zim, I have $8,960 invested. My investment's worth $11,500. I have an unrealized gain of 29%. And I think there's far more upside, because if they could just get to $40, man, this will be a huge winner. This will be a 3-bagger, 4-bagger. And I think that is possible if freight rates continue to rise the way they've been rising. So there's a pretty good Reddit group that follows Zim. And if you go on Reddit and search Zim, you'll find that Reddit group. And I encourage you to follow it if you're an investor in Zim, because that's a very active Reddit group. And usually people are really tracking shipping rates, and it's been good to be a member of that. I've gotten a lot of value from it. All right, good one. Patagonia, a 3-pack of good companies. All right, Everest Group. Okay, we covered Everest. Do I invest in real estate? Omar. So the answer is yes. So I've invested in residential real estate that I rent out to people that rent out the residential real estate. I have long-term rental real estate, and I also had a short-term rental real estate in the form of a couple of vacation rental properties. I sold those in 2022. I've looked into commercial, but I've never pulled the trigger on any deals there. It's just a little trickier there. And right now, I believe real estate's uninvestable right now. Prices are way too high. Interest rates are high. Rents have not kept up with real estate prices. And I think I could do far better investing in stocks, bonds, other vehicles that are less risk. I think if we have another correction like we had in real estate around the 2008 timeframe, real estate's one of those investments where you can lose a lot of money. People forget the past, but back in 2008 in California, as an example, people are losing 40 to 60% of the real estate price on an asset. Meaning, if that asset, that real estate was sold for 400,000 in 2007, you woke up in 2009, 2010, and it was worth 50% of that, 200 grand. So you lost 200 grand on that investment. Those are big losses. And I think those days are coming again. And I'd rather buy after we see a good correction in real estate. Right. Going to random. Not sure. Oh, there was just another comment there. Okay. Random. I have a bunch of such stocks I've been looking at. Cool. Okay. So Shadow Guy. Yeah, I was talking about the tech museum. Intel has its own museum. Okay. I didn't know about that. I gotta check that out. I'm a fan of technology. I think it's neat to see how companies built these technologies. All right, looks like Random wants to look at a couple more. Have a look at Sigi, Otter 2. So these companies, what industries are they in? So insurance, I think we looked at that in the last live stream. And again, I have Allstate, and one of the reasons I like Allstate is the name recognition. Otter Tail Corporation. So electric, this one's interesting. Okay. That looks good. Yeah, thanks for the suggestions on Otter and the other one, CG. So Allstate is my pure play insurance stock, and I started playing it around this time frame quite a bit, and I've done well with it. It's gone up nicely. I think insurance, is if you look at Warren Buffett, he did really well with Geico. I think that he owns all of Geico now. And what he realized is insurance companies, they collect all these premiums when people buy insurance, and the insurance company gets to invest those premiums into bonds and places like that. And then they make money on that. And then they pay back, they pay the policyholders when there's a claim. Overall, the actuarians make it so that they don't pay out more than they collected. They usually have a little bit of profit there, but then they're also profitable by investing the money. With interest rates going up and they making more money on bonds, I just thought it was going to be a good combination. So I invested in Allstate. And I also invested in Prudential, which is more life insurance and other securities. On Allstate, I invested $16,166, and my investment's worth $20,734. So I'm up 28%, and they pay a 2% dividend. So that's been a good hold. And then Prudential is up 25% on my investment of $12,600. So two good winners there. I thought the logic was there, and I invested in them. Their fundamentals are sound. All right, so next one here, still have CF, and you still have CF, and the answer is yes, I do. Still have CF Industries. I have about $10,000 invested. This one here, so I'm going to tell you a little bit of my work history and tell you why I invested in CF. So my first job out of college was working for an oil company. I was an accountant. And one of the first posts that I had was working for their division that did fertilizers, pretty much the same industry as CF Industries, selling urea, which is made out of natural gas, to farmers, and they use that as a fertilizer for their crops. That's what these guys do. So these guys are selling a commodity to farmers, and I think it's a stable play because obviously we're going to need food. Farmers are going to need the fertilizer, and it's going to be just a natural, or I should say, a consistent performer. So I still own CF. It's part of my income portfolio. They pay a 2.5% dividend. They value, fairly well based on my calculations. I have a discount on their stock of 57% because I think they cash flow really well. And it's been, I'm up 1% on it. It's kind of had a weird kind of graph. It was going up really nicely. I was feeling good about it during this zone. And then it came down pretty severely. I think the higher oil prices scared investors, but hopefully it recovers and starts going up soon. But I don't think I'm going to be selling that stock anytime soon. So good question. And then, all right, cool. So this one here is from Legend. Procore. I think I heard of this company. If I remember right, these guys do software for projects. Yep. Construction platform. Yeah, I'm familiar with these guys. Market cap of 10 billion, revenue of 950 million. So you're paying about 11 times revenue. They're losing money. We'll take a look at that. Forward P 100. Ooh, that's a little high. Analysts think it's going to go up in price. Okay, interesting. So really good growth. Great growth. Okay, that looks good. Cash flow looks okay. Not great, but just okay. If we look at their PE, the earnings per share, they're supposed to do 70 cents this year, 99 cents, really good growth. So that looks good. Procore looks good. The one thing I would put out there is I think commercial real estate is either in a pretty good recession or is going to get into a pretty good recession because, office space, right? Employees are not going to the office anymore. So office space is pretty overbuilt. And then also the one area that's booming is multi-family commercial where you have apartment buildings. That's booming. But certain parts of construction are not. They're really slowing down. So I would get my head around that and see, do I think the economy is going to be good? That Procore depends on because that's really going to affect them. But I think it's a pretty good stock to take a look at. I like software companies, and these guys are definitely a software company. All right, so let me make a quick note. Thanks for the question. Good one. Shadow Guy. UBS. I don't know the story of what happened to them last year, but let's take a look. So this is UBS. I believe this is the financial services company out of, wow, it's a good chart. Good chart. So they provide financial advice. They do wealth management, asset management, investment banking. Okay. So these guys, wow, 112,000 employees. Okay. So $87.8 billion market cap, revenue is 48. So about, you're paying 2 times revenue for the company. Net income's really high. 33 billion. Holy smokes. Net income is like 40% of its market cap. Man, they're making money. Forward P is 35, and they have a low dividend rate, probably because their stock price is up. If we look at 1 year, up 36%, 1 month, down 12%. Oh, that's interesting. If we look at their growth, they grew nicely in 2023. 2023 was a down year. Okay. Now, when it comes to a company like UBS Group, I don't use discounted free cash flows, and I do use earnings per share. but actually go and look at their book value, and I look at their book value to see if it's growing, because that's how you value um, banks and companies that are more finance related. And I think book values. Sorry if I'm giving everybody a headache. 1 second. So balance sheet, book value per share. So book value has been expanding. 15 to 24 looks good. So book value is expanding. Looking at earnings per share, in 2024, it's going to be $1.11 per share, which went down significantly from 2023, which was $8.45. Man, what a year. And then it's going to begin to grow from that point. So if we value, let's value this one really quick. It's $1.11. And let's see. All right, so I'm going to copy this guy here. So this is a model where I'm valuing based on earnings per share. Okay, so it's $1.11. A P of 24 is reasonable. The growth rate going forward looked like it was going to be 5%. So the value per share should be about $27. And this company was priced at $27.38. So they're fairly priced if you use their earnings per share. The piece that I would want to get my head around is what happened with earnings per share. This is a pretty big downturn. Like you're going 22. You did $2.25 per share, $8.45 per share, and then it went down 86%. So what happened? Was there a huge investment banking group really successful and they can't keep it going? That's just a huge drop. But the thing that's impressive is if you look at their chart, their stock keeps tracking upward. So there's still confidence in the stock. So I would look at those areas. I already own, I own quite a bit of financials. I'm careful not to own too much of one sector. When it comes to financials, I mean, I own Robinhood, StoneCo, PayPal, Coinbase, Prudential, Allstate, Citigroup, US Bank, Ally Financial. So collectively on those, I have a little over 200,000 invested in that sector. So I'm careful not to put more money into that, one sector. There's a difference like Meta. I have a lot of money invested in Meta, but that's Meta. It's a phenomenal company, big brand. Alphabet, Google, same thing. Again, big brand. Uber, very well known. I think it's gonna have a big future. But UBS looks like a quality company, and I would do my homework on it and make a good decision on it. Hopefully, you bought the stock, shadow guy, way back here, and you're sitting on a really nice gain. You skipped OTTR. Hey, sorry so random. I did talk about it lightly. I didn't look at it closely, just because we had looked at a couple of insurance companies. And I kind of moved on. So sorry I didn't analyze it. Yeah, Credit Suisse. That's what I remember. I did buy Credit Suisse bonds, and it paid really nicely. I think I was making 8-9% on bonds as a yield, for bonds issued out by Credit Suisse. So yeah, it looks like a really solid company. Yep. And they're a big bank. Cool. All right. So Brian Silva asks a really good question, which is how do you normally select your entry point on a new holding? You perform any type of technical analysis? Okay, great question. Because I think, you know, the way that I invest is a choice, is like, and the lesson that I would like want to put out there is I think you got to invest the way that it makes sense for yourself. Things that you can really feel like this is going to be the best path for me to be successful. So let's look at a newer investment that I have is Intel. We just talked about it, right? So Intel. And so if we look at the last year chart, this has been, an upward chart. This is kind of like the go AI, everybody's going to buy AI, and then they started to go down. Now, I am willing to admit I am not smart enough to think, oh yeah, I can pick this date, October 26, 2023. It's going to have a pullback followed by a really nice run up. I don't think anybody's that smart. If you were, man, you'd be making billions, maybe trillions of dollars. But what I am wise enough to do is look at a company that I just think this is a great company and average in my buy over time. Now, I bought some shares near the low point of Meta, but I didn't buy like $100,000 worth of shares. No, I was buying $500, $1,000, $500, $1,000. And over this period, my average entry point was really good. So my decision to buy a company, and I guess I could cover that really quick, is I'll go through my checklist of what I look for in a company. And basically, this is my criteria. And I try to keep it simple. I don't have like a 27 page checklist to go out because that's just too much data. It has to be very clear, concise. And I follow kind of like Peter Lynch, his suggestions, a great investor. I really want to buy into the company. If I can't buy into the company and the story, then I shouldn't invest in that company. I shouldn't. I should try to understand their business, try to understand that they have a competitive advantage or it's a rebound, stock. I'm getting a really good deal and really buy into the business. Do I buy into the rebound story of Intel? I want to make sure that the balance sheet is a good balance sheet. And then is there a discount? So when I decide, hey, that's a good company to invest in, and then coming back to a stock chart and just keep averaging in, and I try to buy on down days. That way I know, okay, over time, I'm going to buy a very good company. And over the long period of time, the stock's going to rise. So that's how I enter a position is I make a decision on the company and then I average in my buys. Technical analysis. I'm not a technical analysis guy. I think it's interesting when people look at data. My background around data and data science. I have an undergraduate in accounting. My strength is probably mathematics. And then I got an MBA and I really enjoyed portfolio management. And I think that data, my opinion, you can really get lost in data. And data can tell you a story that isn't going to happen, in my opinion. And I think as I look at people that are doing technical analysis and they look at certain support levels and so forth, I think they can really support that theory in conclusion until they can't, until they get surprised, until a week happens similar to right here, right? The market starts dropping and then their technical analysis is completely, been debunked. Or you go back, here's the S&P, right? So let's go back further. If you look at the technical analysis that was happening during this era, it was all broken. But what was clear in this era of the stock market in 2022, we were definitely selling off. We were definitely in an expensive market. So it was a great time to buy, a great time to invest. And my approach is find the best companies that I believe in that have very good fundamentals. I don't have to be exact in buying the stock at the perfect time. I could just buy it during a good range of dates and just buy a good solid position. I've built up really strong positions in Meta. That's my biggest position. Alphabet, Chevron, Uber, and I've done it under those terms. So that's how I approach it. It fits, how I like to invest. I'll tell you a quick story around Uber. So if you guys know who Bill Ackman is, no, not Uber, sorry, Netflix. So here's Netflix. This was a huge buying opportunity. And Bill Ackman is a super investor. He's a billionaire. He's really successful. And he's probably 100 times smarter than I am. And he invested 1.1 billion in Netflix. And he lost $400 million on that investment. He bought around this range right here. He thought, hey, I'm smart enough and good enough to see that Netflix stock came down this amount, which is nuts that Netflix is such a good company. It's a number one leader in streaming, just a lot of things. I can spend the whole day talking about Netflix. So he bought here and he put 1.1 billion and he lost 400 million and then he got out. And I started buying like in this range and I like tripled my money. And again, Bill Ackman's 100 times smarter than I am. But that's how difficult it is to pick that one day when you're just going to drop a big, investment in a stock. The best in the business can't do it. So I'm not going to pretend that I can. I'd rather just know I want to buy Netflix. I think Netflix has an awesome future and the company is discounted and I'm going to buy it. And I bought it and I did really well with it. So, all right. So Otter is an electric company. All right. So let's hit Otter because I don't think I covered it right. So are we talking about Otter Tail Corporation? Utility. Yeah. Okay. We're talking about the same company. Yeah. It's a manufacturer. 3.5 billion revenue. So you're paying 3 times revenue. Net income is good. 2.2. So these ones, I would tell you that small companies haven't done really well for me. I look at fundamentals and they look great, but nobody buys the stock. And it just kind of sits there. And I'm like, what the heck? Whereas well-known companies, they tend to just perform really well. So this one here, the fundamentals look good. I would just kind of caution you, or at least my investing experience and kind of experience with small companies is it's really hard to sit on a stock and you own it for 2-3 years and it doesn't do anything, which is weird. And this one here, it does very good free cash flow. So you're doing about 117 million of free cash flow compared to their market cap. So they're doing about 3-4% of free cash flow. It's very good. Okay. And then their forecast earnings per share is good. Yeah, I would put that into a valuation model and see what you come out with. It looks like a sound company. I would just put it out there that I've kind of been, if you study small and mid-cap stocks over the last year and a half, they have underperformed the S&P big time. I have some quality companies in my portfolio that have just lagged the S&P. where the big stocks have just done great. It's almost like if people recognize the name, they're more comfortable investing in it. So that's why the small caps like DocuSign, I just talked about DocuSign. That's kind of a smaller name, but a lot of people have heard of it. And it still doesn't perform up to what I think the fundamentals would say. So that's an example. All right, Shadow Guy. Are you a fan of hedge funds? So the way I would answer that is that, I liked listening to some of the hedge fund managers, but I listened to them under, conversations and interviews just so that I can understand sentiment of the market. Like when you go on CNBC and you have like a hedge fund manager and they're there with an agenda, like, hi, I want to talk about this stock and I'm going to tell you all the great things about this stock. I don't get a ton out of that, but there's certain YouTube channels where these hedge fund managers have like maybe a 30-minute interview. It might be Bloomberg that has an extended interview, or it might be, one of these hedge fund managers. And what they end up talking about is, they're feeling about where interest rates are going to go, the economy, certain risk factors. And that's where I get the value. I don't get direct like investing ideas from hedge fund managers, because if they're willing to put something out there, that just means they have an agenda. They want you to buy that stock. But I get a lot of value from them, kind of sharing how they see the market, as of April 2024. So I actively do that. One channel that, let me try to find it really quick, that I really liked, where it gives me interviews of that type, is here it is. So it's the Compound. So here's a hedge fund manager, the Compound, right? This guy's Josh Brown. And if you guys have seen him, at times he's kind of brash, he's kind of overly confident, and he kind of like when he comes out on CNBC, you get a snippet of him, and that's where I kind of formed a negative opinion of him. And I ran into their channel and I started listening to it, and these are extended conversations, and they get some really talented hedge fund managers, the Compound. And if you listen to it, I pick up some really good information about where's the market, sentiment, some big factors that are affecting the market. How do they think and how do they operate? So I get a lot of value from this channel, and I'm glad that I was able to find it. I had a bias against this guy because he would come on CNBC and kind of come off as being really brash and overly confident. And I'm glad that I was able to get some value out of his channel. All right, good stuff. So Brian Silva. I don't know if I would have the mental fortitude to hold on to those situations. Yeah, man, investing, right? I think Warren Buffett says that you have to get your emotional strength and confidence and stamina. You have to establish that before you invest. Investing, if you study mathematics and if you study markets, you realize that if you diversify correctly and you invest with a long-term horizon, you're gonna win. The hard part is, if you ask me, give me a stock that's gonna give me a 10% return in the month of May, can't do it. Can't do it. That's really hard. Now, if you ask me, give me a stock that you think is going to do 10 to 15% over the next 5 to 10 years. Oh, okay. Let's talk about Uber. Hey, let's talk about, Meta. Let's talk about Alphabet. Then I've got a length of time where I believe in the market. Like if you study history and what markets do, mathematics, business, fundamentals, then I'm confident that over time the conclusions that I am making or I'm theorizing about a company, I would say like 7 out of 10 are going to be correct. I'm going to have a couple of losers there. I'm going to have a couple of companies that surprise me. I'm going to have a couple of companies that I lose money on. That's okay. As long as I have 7 winners out of 10 over a 5-year period, I do really well. So that's how I would say you got to really, put money in that you don't need it. I have different parts of my portfolio. I have a growth portfolio. I don't need that money. I won't need it for 10 years. I may never need it. I might leave it to my kids. I have an income portfolio where it's like, I may need that money in 5 years. And then I have a bond portfolio where it's like, I may need that money in the next 5 years. I don't need any of the money that I've invested immediately. But if you have different buckets where there's a bucket that you may need the money, well, put it in low risk. And then have a bucket where I don't need that money for 10 years. Play the market over the long haul. Invest, with the objective of making a high return. It causes for maybe a couple months or a year like 2022 where things look pretty darn awful in 2022, but then it came back and roared back, and those same stocks did 40% for me in 23 that lost 20% in 22. So all right, so I think this is going to be the last one. Viking Therapeutics, if you have time. Viking Therapeutics, never heard of it. Viking Therapeutics. So, healthcare company. Okay. So this is a healthcare company, 27 employees, market cap of $8 billion, no revenue. Okay. Strong buy, price target of $95. Financials. So they don't make their pre-revenue. So I can't value this company, and I'm not a life sciences guy. I'm not, in that industry. So I couldn't really give you any opinion here. They're using cash as expected. And I can't give you an opinion. I'm bullish on healthcare, but I own healthcare companies that are already, generating revenues, profits, and so forth. But I cannot state anything on Viking. If it's pre-revenue, it's not my game. If it was an industry where I had firsthand experience, maybe I might go into an investment like that. But I wouldn't know where to start with Viking Therapeutics. I'm not a doctor. I've never been a nurse, and couldn't give you an opinion. But I appreciate you asking the question. All right, so we're going on an hour and 8 minutes. Awesome live session or live stream. Really appreciate everybody attending, and I hope you all made some good money this week. It was nice to have an up week after 3 negative weeks. And again, I view those 3 negative weeks as good. That's good medicine. We had stocks that were just going up and up and up, and we had a pullback, and especially some stocks really saw their shares go down in value. And that's just a really good market. Meta went down more than 10% yesterday. That's my biggest position. So it was fun to lose over $20,000 on one stock. Yep. And then, but the following day, boom, Alphabet was up about 11%. That's my second biggest position. So I made a good part of that back. And that's a good market when you have, hey, you know what? Prices are going to be coming down as well as going up. And the investors that value on fundamentals and good value techniques, we'll buy when the stocks get pulled back so we can get a good entry price and over the long haul make good money. So, all right, guys, great doing a live stream. Everybody take care.